Hey everybody, JJ here, back again with another Saturday of Zoom networking. Our guest speaker today is just a great guy, heck of a great guy. He's an expert in this field. Um, can't say enough about this young man. He's been on with us before, talking about his topic. I'd like to introduce my good friend, Mr. Mike Stelljes. Mike, how are you?
Doing good. Doing good.
So, hey, for those that don't know you, where in the country are you located?
North Carolina in the Charlotte area.
Oh man, I hear that's just one of the most beautiful garden spots in the country.
I enjoy it. A couple hours from the beach, a couple hours from the mountains. It's nice.
Oh man, that sounds like heaven to me. Hey, so your topic today actually is real estate investor insurance, being properly insured and not grossly overpaying. Um, how long have you been in real estate insurance, Mike?
Well, I've been in the insurance industry since 1993, but I started doing the real estate investing area in 2017.
And how did that come about for you, getting from just regular insurance into investing?
Yeah, so I've always done contractor related insurance. And in 2010, I started concentrating on builders, home builders. And then in 2017, I got introduced to a real estate investor that started doing more home building. And he actually used to be on the Fortune Builder Advisory Group, really well versed, wrote some of their literature. And he's like, "Hey, Mike, we give a pretty good playbook on how to do real estate investing, how to set it up, attorney, CPA, all that stuff." He goes, "But insurance is one of those areas they really don't talk about. They gloss it over or don't talk about it at all." So he says, "What can we do here?" So we got together and I actually went to my home builder carriers and just said, "Look, we should be able to write these real estate investors the same as home builders." And I laid it out for them and we went through it and I said, "Give me 3 years. And after 3 years, we'll compare how the programs are tracking, not just in terms of premium, but loss ratio, loss history." And so here we are 7 years later, and the loss ratio is actually performing a little bit better than my home builders, simply because of the concentration of risk. Some of my production home builders are doing 100 homes in a subdivision versus real estate investor that's spread out. So as a result, if you get a theft claim, usually with the home builder, they're going to hit several at a time. But yeah, so that was the genesis of it. And then you mentioned Bob McIntosh the other day, right? Knowing how good he is. But so the three of them put together a mastermind down in Cancun. Said, "Come down here, Mike. Let's talk about it." He had about 75 of his contacts come to it. And yes, yeah, so that's really where the jumping off point. So I was able to write the majority of those guys. And 7 years later, I've got roughly 200 real estate investors in 42 states. So even though I'm located on the East Coast, I write insurance for you got real estate investors nationwide.
Now, Mike, let me ask you. Now, I was going to ask you work in multiple states. Can an investor live in one state and you can insure their property in a different state, or do they
Yeah,
have to?
no, absolutely. So I had one 3 months ago. He's actually based in Colorado, but right now he's doing most of his work in San Antonio, Texas. So yeah, absolutely. It does not matter where they're located, and they could be doing deals in multiple states. We can handle it.
Now, do you find that because you've been in this game for a while, you've been around the investment community, do you find that most new investors are really not aware of the importance of insurance for their
It's
transactions?
it's not new. It's not even new investors, JJ. I literally yesterday afternoon was talking with a gentleman out of Staunton, Virginia. He's doing between 60 and 100 a year, and he's been doing it for about 8 years now. And right now, he is getting 60 to 70 policies a year, which is insane. Can't believe I don't know how people manage it and all the paperwork and stuff that comes with it. So he was very happy to hear about my solutions, basically taking 70 policies down to two.
Wow. Now, how does that happen? Do they put multiple properties on one policy or?
Yeah, well, you don't even have to do adding properties. What the solution we're going to be talking about is a blanket builder's risk policy. So once you put, and it's annual reporting. So once you put it in place, you just run with it. You go for a whole year. You build as much as you want. You flip as much as you want. You do as many as you want. We'll estimate in the beginning what you think you might do, and then we just true it up at the end of the year. So you have one property. It's actually called builder's risk, one builder's risk policy and one general liability policy. That's it. And they both cover everything you're doing, any of the states that you're working in, and we true it up at the end of the year. So I'm not kidding you. I took this gentleman from 70 policies down to 2, and more importantly, gave him the proper coverage at a reduced cost. I mean, it's a win-win-win.
Wow. You and I were just talking the other day about someone that had a property and they didn't have it properly covered.
Yeah, absolutely. I mean, I see it every day, every single day. So I'm friends with this person on Facebook. I'm not personal friends with him, right? But I know of him. Yeah, and he posted just on last Monday, I believe. And he's like, oh my gosh, guys, pay attention to the insurance. Here's why. He just finished up a deal. He was just days away from closing. And that's when you have the most exposed, right? Because you've got the existing structure plus all the renovations almost complete. And he had a claim to the tune of $70,000, and it was not covered. Why? Because he had a property policy, and most property policies are going to start excluding coverage 30, 60, 90 days in. So he was just like up in arms. He's like, how did we get a policy written this way when we knew it was going to take me 5 months to write to get the work done? So yeah, he had to eat $70,000. And there's way worse situations, but in this particular case, he could eat it and still survive. And that's what we're going to talk about in a minute is the way I present this is it's risk tolerance, right? What your risk tolerance is managed through risk transfer. So how do we take that risk and transfer it and mitigate it?
That's excellent. So, hey, jump right in, brother. Fill us in. Where do you want to start?
No, I appreciate JJ. First of all, thank you for everything that you do. I steal your little slogan every day. Your network is your net worth. Can't emphasize that enough. The more groups you get in front of, even the real newbie real estate investors, they are going to shorten their learning curve tremendously, right? Because I like hearing about the stories where you don't always have the successes. I don't need all the time seeing yachts and Rolexes and boats and cars saying, oh, I'm doing so great. You want to hear about some of the situations that they got in where they didn't necessarily check every box. They had a situation, because you're going to learn more from that, right? So seeing these guys being in part of groups like this, it's exciting for me to be part of groups like this, because for me, I'm the same as JJ in terms of I want to bring value to this community. And the more that you get the words out, the more you're able to help people, right? And I truly enjoy that. I love what I do, and I love this area of insurance because just like the gentleman on Friday that I was talking to, he's like, I've been doing this for 8 years. We real estate investors, we get together, we never talk about insurance. It's not even something that comes up, and that part doesn't blow my mind. But what blows my mind is, once these guys find out what the solution is or what a better solution is, why the majority of them don't sign up. We'll do some of these podcasts and I'll have 15 or 20 reach out. There might be reaching 200 or 300 people, but it's kind of out of sight, out of mind. So it really does blow my mind how easy this can be. So to get in, I'll be pretty short because, like JJ said, we'll take 2 or 3 questions and then reach out to me individually. My website, it's www.mikestelljes.com, STELLJES. That's a great resource page just to kind of see what I do, get a flavor for me. It's really a page to just kind of legitimacy page. You know what I'm saying? It's not necessarily there to drive business. It's just more to show what I do. What's your tolerance for risk? Early on, they talk about how life insurance is an example. You're supposed to get term insurance, invest the difference, right? Middle age, you take the investments, right? You're risky early on. You want the quick returns. As you get to middle age, you want to balance your portfolio out. And then when you get further along, you want to take less risk. So you're going to go into things like government, 4%, things like that. So here's how real estate insurance works. You are 99.9% of the time, all you're trying to do is meet a lender requirement. You don't know anything about insurance. You just want the lender, give them a property policy with some liability built in. That's all they want. That's all they look for. They never review the policies, guys. They do not. They don't care. They're checking off a box. They've got 50 things to do to get your loan approved. You guys have 136 things to do to get your project completed. So this all gets lost. And what they're going to do is they're going to write you a property policy. And a property policy is truly designed for occupancy, not vacancy. So when you have a policy that by default is supposed to be for occupancy, you're going to run into all sorts of problems with coverage. Now, every now and then, I'll run across a carrier here and there that will write a property policy and add on a renovation provision or endorsement, but it's far and few between. So the first area I want to talk about is risk transfer. So there are two things that you guys can do that aren't even insurance related. Number one, get a subcontractor agreement in place with every sub that works for you. Now, if you've got a general contractor that's doing the turnkey and doing all the work, he's still considered a sub to you. So you want to present them with the subcontract agreement that's going to cover all the legal stuff and a sectional insurance. They'll sign it, send it back to you. Ignorance is not bliss. So when you normally go to court, it's not just the insurance policy they review, it's the sub agreement. So if they are agreeing to these warranties, they're warranting their work, these different things, they're warranting to you that they're going to have the proper insurance. Well, that's what the courts are going to look at, or arbitration. They're going to look at this and say, look, we don't care what your general contractor policy says. You're legally bound now to your real estate investor to make good on this claim. The second thing you do is you want to take a little peek into those general contractor policies. You don't have time to go through all the sub policies because, unfortunately, a certificate of insurance is only going to tell you that they have coverage that particular day with this carrier. And they may give you a limit, but you're not going to know what their coverage is. So one of the things that you can bank on is the industry averages. 10 to 15% of the subs that are working for you do not have the coverage for what they're even doing, right? So if you got a handyman that's doing all the work and he's paying $600 a year for general liability, I can guarantee he doesn't have coverage for roofing work. And there he is doing roofing work on one of your projects. So that's why you want to make sure they have the proper coverage. You want to have a sub agreement, and that you guys have a proper policy in place that if someone doesn't pay their premium, their policy's canceled, or doesn't cover certain things, that you're covered. So that's part of the risk transfer before you even get out of the gate, right? The good thing is with real estate investors, if you're not building new construction from the ground up, you are not subject to the statute of repose, right, in your state for construction defects. North Carolina, 6 years, South Carolina, 8 years, or some states like Pennsylvania that even get into double digits. Meaning if you build a house from the ground up, you are on the hook for that house for the duration of the statute of repose. So they can come back any time during that period. The good thing is real estate investors, when you have an existing structure, you're not subject to the statute of repose. So it makes it a little bit easier. But the risk transfer is achieved through having the controls in place before you even get started. Make sure these guys have insurance, right? Get a sub agreement in place. So now we'll talk about the three prongs of insurance is what I specifically do. The first one is the actual builder's risk policy. I'll give you two examples. I'll keep them short. During one of JJ's podcasts that I did 2.5 years ago, I was linked up with a real estate investor in Hawaii. Very popular. He does a lot of podcasts, he's out there on Facebook. It's very prominent. And I said, look, we can help you out because if you're getting a property policy, which he was, I said, we know that property values in Hawaii are going to be the most expensive any of the United States, right? So he sent me a copy of a policy, and I called him back and I said, well, we already know a property policy is garbage. It's not going to, it's well, not garbage. It's not going to cover what you need. It's expensive. But I said, how much is the actual structure worth? And he said, well, it's worth about 500,000. Well, the policy was written for $1.6 million. Why? Because that was the value of the loan, which included the land value. Well, we don't insure land. So why would you pay a premium on land? So I said, look, we're going to give you a builder's risk policy. It's only going to cover for the existing structure plus your renovations, because that's all you're doing. So by default, I'm already reducing premium by that, the cost. Then the next stage, I said, how many projects are you doing? Well, I'm doing about 50 a year. So you're getting 50 policies a year. What a nightmare. How do you keep up with it? How do you report a start? How do you finish a start? How do you add a policy, forget to add a project on? How do you cancel it? It's just, I've only know of one company that does a monthly reporting option, but you still have to remember to report it, and you still have to remember to delete it. But the issue with those guys, it's still property driven, and you're going to have exclusions in there that you probably don't even know about. And on top of it, it's you're having to report it monthly. It's a hassle. And the one thing I really don't like about that program is they will stick the address in a computer, and they'll spit out how much coverage you're going to get, if the deductible is going to be lower or higher, whether they're going to exclude theft. And I call it redlining, right? That's redlining in the industry from a loan standpoint, is picking who you give a loan to or not. Well, I don't like a carrier deciding what kind of coverage you're going to get based on where you are, meaning changing the coverage. Now, look, in California right now, obviously, the biggest thing we have to underwrite is the fire. It's not landslides. It's not earthquakes. Right now, it's the fire hazard. There's soil issues in different parts of the country, but we base it on we base those exposures on the rate. So we may charge a higher rate, but we're not going to change the coverage. So builder's risk is a blanket policy. I'm one of the few agents. I am the only agent with the carrier that I represent that is able to do real estate investors on a blanket policy. The only one. So it's an advantage. It's exclusive, but I've got enough of a book with them. I've got a track record with them, so they trust me. And again, we're going to have some controls in place to make sure that we minimize the exposure. But how does a blanket builder's risk policy sound versus property policies? Because a builder's risk policy is designed for vacancy, right? Because this is what new home builders, if it's a ground up construction, well, it's empty the whole time. If you're buying a deal, it's going to be empty the whole time. It's not going to be occupied till you're done. And that's when builder's risk coverage will end. So it's blanket, it's annual reporting, it's one rate, it's one coverage. We estimate what you're going to do at the beginning of the policy, and then after 12 months, we true it up. The beauty of truing it up is it's an Excel spreadsheet you send us. We're not going to spend hours on an audit. You're just going to list all the properties, all the deals that you started in that 12 months. I don't care if it takes 4 months to complete or 11 months to complete. We cover it under that one rate. We don't cancel and prorate returns like some carriers do, but because my rate's so reasonable and the coverage is better, we don't have to worry about that. So I'll give you one example of a situation. I have a client in Minnesota. They were not a client at the time, Minneapolis, St. Paul area. She sent me a copy of a policy that was a true property policy, and it was written with a reputable carrier. We've all heard of their name before. And I started looking at the policy. Premium was ridiculously high. They only covered it they didn't have enough of a limit. They basically covered it for what the structure was worth and not what the renovations were. Well, we found 3 exclusions in 5 minutes. The first exclusion was, if this isn't your primary residence, we're not covering it. Number 2, we're going to have a theft exclusion. So the most likely cause of loss for 80% of home builders and 80% of real estate investors is what? Theft or vandalism, right? So they're excluding probably one of the major things. But then it also went further into the policy and talked about, well, we're not going to cover if you're doing structural work. So they had 3 exclusions. They paid $3,500 for a policy that would not pay if they had a claim. Now, did the bank accept that policy and stick it in their file? Absolutely, because they're not reviewing them. So that's the first and foremost is builder's risk. And builder's risk only covers the existing structure and the renovation part you're doing. So while it is a property covering policy, it's called builder's risk. So that's the number one. I know the questions I get is, well, what happens if I hold on to the property and turn it into a rental? Well, that's the time you get a property fire homeowners policy. That is not my bailiwick. I don't handle that area. So once you get done with it, if you sell it, we don't do anything. If you turn it into a rental, reach out to any number of carriers. They know how to cover a homeowner or a rental, right? They just don't know how to cover the project while it's vacant. So first is builder's risk. All right, let's go on to now the second one. So there's three areas. The second one is general liability. Under a property policy, it's going to be called premises liability. Premises is pretty much going to cover a Johnny or Susie claim. Somebody jumping into your project, goofing around, 12-year-old gets hurt, right? Even a criminal, if the thief breaks into your house and gets stuck in the chimney and gets hurt, they can sue you. So that's more of a premise. That's all you're going to cover. You're just covering for JJ wanting to come and check out one of your projects and slipping and falling, right? So it's premises. There is absolutely no coverage beyond that. So are you covered for your products, which are the materials? Are you covered for the completed operations, which is the workmanship? Absolutely not. They also are going to put in, it's not even in a property policy, right? But if they do get a general liability policy, they're going to have an exclusion that's going to exclude work done by subcontractors. Well, how much work do you sub out? All of it. So if they're going to exclude the work done by your GC or subs, well, what happens if they don't have the proper coverage? Well, it's going to fall back on you, and there's no coverage for the subs that work, right? So then if you only have a premises liability policy, well, you've got nothing. So you're going to be paying out of pocket, right? Another reason why a general liability policy is important and why you separate it from property or builder's risk and have liability is there are cases where you will not know who actually caused the damage. Everybody did their job correctly and nobody accepts responsibility. If you go to my website, this is a true claim. We make a funny commercial about it. Just briefly, brand new custom home in the North Carolina area. The homeowners lived in it for about 45 days. The wife was in the kitchen, the husband was in the shower upstairs, and all the sewage started coming out of the sink, got on the guy in the shower. And again, this is one of my little funny videos. We did the exact thing. Well, what happened? You do a forensic investigation. They called their homeowner policy. The homeowner policy said, yeah, we'll send people out, but we're going to subrogate back against the contractor that did the work, right? Now, and this is key. Your clients don't know the subs that work on your job site. They don't know their names. Who do we buy it from? We bought it from JJ. That's who we're going to sue. Well, in this particular case, the piping was run in by the city a few feet in. Well, the city of Charlotte's not going to pay for it because they're like, our pipe was fine. The guy, the plumber that actually came in and hooked up the pipe said, well, man, I did good pipe work. There was nothing wrong with it. The concrete guy that came in, and ultimately that's what it was. The pipe cracked, the concrete filled into the crack. So it was just a matter of time before you're going to have the backup. So the city of Charlotte had no liability. Couldn't prove the plumber did an improper hookup. He's off the hook. The concrete guy, he legitimately could have said, I'm pouring concrete, so I don't know if it's busted or not. So what do we probably think it was? Might have been a landscaper or a heavy piece of equipment, right, that ran over it. Nobody's going to step up and pay that claim except for JJ, right? So if JJ says, well, I got to report it to my carrier. You report that to a property policy that's got premises only, you will not get coverage. So in this particular case, I had a proper GL policy in place. We covered it. So it was about a $30,000 claim. But again, nobody wants to lose money on their deals. They don't want to cut into their profits. So when I keep talking about risk transfer, what we're trying to do is mitigate what will happen to you if these situations come up. So those are the first two. We got builder's risk, blanket basis. We got general liability the same way. You're not reporting to me your starts. We don't care. We just, at the end of the year, we audit you. The general liability is going to be based on the sub work, right? So the gross that you pay the sub. So $2 million in subcontracted work, that's what we're going to audit you on. The good thing about either of these policies, if you overpay and we overstate the amounts by a little bit, you'll get money back. If we're a little bit low compared to what you actually do, you pay the difference. Easy peasy, you move on. The third area is workers' comp. Now, this one is the least addressed area, but it carries potentially some of the greatest risk. And here's what it boils down to. If you have a general contractor and it's just one guy doing the turnkey work, his certificate of insurance needs to show that he has GL and workers' comp. And workers' comp's important. Why? Some of your general contractors are going to say, hey, legally in North Carolina, I don't have to carry a policy because I'm just 3 employees. That's fine. He's right. But if one of his employees gets hurt on your project, they can go to the North Carolina Industrial Commission or any state's industrial commission and say, hey, I got hurt. I got hurt on JJ's website. I need workers' compensation, because the sole remedy for an employee's injury is workers' comp. That's where you go for coverage. So the states don't want a bunch of claims in hospitals that are uncovered by parties. So while some subs you may work with are not required by law to carry workers' comp, if they don't have it, you're going to pay the claim. So how do you transfer the risk on workers' comp? You either make sure that they have a work comp policy of their own. Choice B is you don't work with them, right? And then choice C is you provide a work comp policy and you take it out of what you pay them at the end. And here's the example. JJ does a $50,000 renovation. $25,000 was materials, $25,000 was labor. Well, that's what your work comp is going to be based on, the labor only, right? And you divide it out. Don't want to get into all the math, but if he presents you a bill for $50,000, you'll give him a check for $45,000 or whatever the work comp cost is, and you withhold it. Because what will happen at the end of the year when your work comp policy gets audited, well, then you're picking up an uninsured sub, so you'll pay it, but you're just banking what you charge the guy. So builder's risk, general liability, workers' comp. Those are the 3 areas that I deal in, but it's almost always builder's risk and general liability. Workers' comp's a little tricky for the states. I'm actually going to give a plug for a carrier. I have no association with them. I have no incentives, nothing I get back from them. You see the commercials for them a lot called PIE Insurance, right? pieinsurance.com. They write workers' comp in all 50 states. They got different carriers. They'll write you a little work comp policy. Now, my girlfriend was laughing because I use these things called ninja tips, right? So I'll give a couple ninja tips. If your GC is turnkey, he's probably got coverage for roofing. But if it's JJ Dodgers Handyman Company and doesn't have the word roofing in his name of his little handyman company, I can just about guarantee he doesn't have coverage for roofing, right? So you got to really pay attention to some of the trades that these guys are doing or the work they're doing for you. The other ninja tip, you are not covered under workers' comp for work-related injuries. We've all seen these little letters, right? So if you get in an automobile accident, you file a claim with your insurance carrier, your medical insurance carrier. I get letters like this, not all the time, but we've all seen them, right? They'll ask the question, was this a work-related injury? Is there a work comp claim that can be filed? Is there an automobile injury you're involved in? So your personal health insurance carrier does not cover work-related injuries, right? So JJ owns his little flipping business. He's got Blue Cross Blue Shield for his health insurance. JJ goes to a job site. He just cuts his finger, $200, goes to urgent care. Nobody's going to question that. You get out there and you're in the attic and you fall through and, have a $10,000 or $15,000 compound fracture at the end of the day and require surgery. You ask the carrier for coverage there, and we'll take a little bit closer look. So and it's written into the language of a health insurance policy that they will not cover work related injuries. Now you can lie, you can, you can tell them whatever you want, but if they find out, it's just going to be worse on you. But at the end of the day, as long as you guys aren't picking up the hammer and doing the actual work and the actual supervision at the job site, which would create a very high work comp rate, the majority of you guys are going to be covered under a clerical code, an outside sales code, or an executive supervisor code, which the minimum premiums for workers' comp is anywhere from $1,000 to $1,500 annually. And if a clerical rate's only 70 cents per 100 of payroll, and you pay yourself the max per state, 77,800 in North Carolina, you're only going to pay about $700 or $800 for you to be covered under workers' comp. So now, if you're going out and working on a roof and actually doing roofing work, they'll put you under a roofing code that's more like about $40 per 100. So I just want to be real clear that you can provide a work comp policy and cover your uninsured subs if they don't have insurance. You can cover yourself if you want to, but think about workers' comp. Injuries can get into the millions of dollars, right? And I don't say this lightly, but a death claim is always cheaper than a claim where you get paralyzed, right? So you fall from a 5-story building, you're almost guaranteed that you're not going to survive it. That's a quick claim. You pay for the instant medical bills that were taken care of, but you're done. Somebody falls off a house 2 stories tall, they're most likely going to survive, but they're going to have severe injuries, right? That requires a lot of rehab. And if they're a quadriplegic, you could be paying the work comp, or someone could be paying millions of dollars over 10 or 15 years. So it's the least sold area of insurance that I supply, which, believe it or not, carries the biggest risk.
Mike, I got a question about the workers' comp. As investors, we're buying houses, we're bringing on a contractor to rehab the house.
Yep.
There's a contract signed frequently between the contractor and the investor.
Right.
Is it up to the contractor to have? They're supposed to have their own workers' comp, right?
They should have workers' comp, number one. And the beauty of it is, if you're working with the general contractor, right, that's turnkey, he's going to be hiring all of the subs to do the work for him. Well, you're off the hook. It's up to him to collect all the insurance. You see what I'm saying?
Yeah, but my question is, that should be in the contract, the insurance details.
Oh, yeah.
That should be specifically in the contract between the investor and the contractor. There should be an insurance section that stipulates that he has insurance, who's going to be covered, how he's going to take care of that. Okay, and this is something that's kind of new to me, but I think that all of us that are either on the call right now or watching on YouTube, that when we have a project and we're dealing with the contractor, that we need to make sure, because do we count on the contractor to have that verbiage in the contractor between the contractor and the investor? Probably not.
No,
right?
No, most of them won't. And it's right. It's simple. It is solved very simply by a subcontractor agreement, right? Your sub agreement that you draw up, that you present your subs or GCs, is just say, hey, here's the insurance section. You're going to provide me $1 million of general liability. You're going to provide me with $1 million of workers' comp. And it's spelled out very clearly. You're going to name us as additional insured. We're going to be held harmless, primary non-contributory. And I don't want to get in a waiver of subrogation. You ask for all of that. And those are things that 90% of contractors can get, because my real estate investor clients have that stuff built into their GL policy, right? It's all built in. So if they have a lender that wants to be named as additional insured, we can name them. So these guys can provide this. Now, you'll get some pushback every now and then. But yeah, if you spell it out that they need to be providing, they're all going to have general liability. It's not expensive. Workers' comp's a different story. Now, I will tell you one exception. It blew my mind. In Texas, you can waive workers' comp. I don't know how they do it, but it's basically the employees sign like a waiver form, and there's another way, not necessarily to get coverage, but they're not required to have it. So imagine a roofer in California that has to carry workers' comp and pay an outrageous rate. That guy's paying hundreds of thousands for his insurance. Go down to Texas, all you got to buy is a general liability policy. So it's nuts. I mean, think about it. I tried working on a couple of roofers down in the Dallas Fort Worth area, and the premium that they pay on the GL might be a little high, but they don't have to cover workers' comp. It's huge advantage for those guys. But you've got to make these guys provide those general liability and workers' comp. I just don't think I don't think you have a choice. I don't think there's a way around it. Now you're going to get pushback on the workers' comp, so that's why if you provide your own and cover those uninsured subs, then you're protecting yourself one way or the other. So that's it. I mean, I know I covered a lot. I know it sounds simplistic, too good to be true, but the rating structure on the builder's risk, it's an annual blanket policy. The only time my office and account managers hear from you is when the lender needs evidence of coverage, right? Evidence of insurance for builder's risk, and then a certificate of insurance for the general liability. It's the only time we hear from you. I don't care when you start a project. I don't care when you end it. Now, let me just talk a little bit about the structure, because we're going to give you specific limits. We're going to give you a limit for the overall renovation, new construction. We're going to give you a limit for the existing structure. So the majority that I write is $350,000. And again, that does not include land. That's just the value of the house. Now in San Diego, California, I'm going to be providing an existing structure limit of probably $700,000 or $800,000, right? Because it just depends on where you're doing the work. If you have a project that you just run across, like a historical project that's going to require, you're buying, it's just a deal you can't pass up. Your average may be 200 per house, but you run across one that's $1 million, the existing structure value. That's when you'll give me a call and just say, hey, all we do is endorse the policy to say we'll give you up to the $1 million existing structure limit. We know it's that one structure, and then you just report the $1 million at the end of the year. We don't have to do anything at the time with the policy other than a quick endorsement. Those are rare. We don't have to make that adjustment. Very, very seldom. So my custom home builders, $1 million for new build work, right? But now I've got some that are doing $3.5 million, $5 million projects. We just keep bumping up that new construction limit. So with you guys, very simple. The coverage is very straightforward. All the coverage is the same for any of the projects you do. You'll have anomalies here and there, but if you're getting private money from guys, some of them don't even ask about your insurance. We may not hear. I've got some clients we don't even hear from for the whole year because they're dealing with private money. They just prove on their end that they've got insurance, send them copies of whatever it is. We don't hear from them. So that's it in a nutshell. The guys that are doing multiple flips, we take their policies down to 2, regardless of how many they were doing. And that's what I'm saying. We're more cost effective. We're going to give you much better coverage, and just the time. I can't imagine the paperwork and admin that you spend. It could almost be equal to paying a salary to someone just to keep up with that kind of stuff that you don't have to worry about anymore.
Yeah, now Lord knows that as investors, we have a ton of admin work. Hey, Mike, I got 2 questions about this.
Yeah.
We're doing a property. We're engaging a contractor. We need to have a contract with that contractor, which is going to require insurance.
Yep.
Now, anytime we're signing a contract as an investor, we should always have an attorney review that before we sign that contract, correct?
100%. Well, but we also, here's the good thing, is I have what's called a short version contract. I don't mind telling you the carrier, it's Selective Insurance. Now, Selective is just an insurance company. I don't do my real estate investors with them, but they're big in the industry nationwide in most states. But they provide me with it's a 3-page short form subcontract agreement. And what we do is, because our general liability carrier that I do offer these guys, they are required to get a subcontract agreement put in place. But what you do with this subcontract agreement, it includes all the legal stuff. It's not just insurance, and they've covered their bases. And when you go through that sub agreement, it's very good. It's short, but what you do, JJ, is you just send it to your attorney, and the attorney will just look at it and say, yeah, this looks pretty good. Now, I have some clients that say, I've got my own sub agreement, and we look at it and say, you're great. Some just say, I'm going to adopt the selective agreement and use it and don't make any changes. But then I have some that say, I'm going to pull certain things out of what you're showing us and put it into my contract or put an addendum in it. The end of the day, the point is you need to have something. But yeah, it's got the legal stuff in there. It's not just insurance.
And I guess what I'm getting at is, we always need to cover our bases and don't, I'm going to use the word trust. Don't just trust your contractor to say, here's my agreement. You need to sign my agreement. You sign my agreement. We can work on your project now. I mean, you need to make sure, guys, as investors, that you have your insurance in place. You cannot always count on the person coming to you with their agreement that's going to cover you, have everything that you need. And I don't mean covering insurance wise, but that it stipulates that they're going to have what they're supposed to have. Because
Right.
as a contractor working on your property, they're going to need to have certain coverage, and you're going to need to have them sign an agreement saying that they have the insurance, they have the coverage,
Yep.
not just sign
You're,
their agreement saying they're going to do the work, you're going to pay them.
exactly. You're transferring the risk because who's doing the work? The sub. Who should pay in the event of a claim, right? The sub, not you. So, but let's flip the tables around, JJ. It's not, you also just can't take the word of an agent that you're working with. And I don't mean that in a disparaging way. It's just that this is a very gray area, a hot potato, and an area most agents are not aware of. Because again, if JJ sends me a deal and just says, Mike, I'm working on this deal. Here are the requirements from the lender. Oh, I can write you a property policy, JJ. That's all they want. I'll write you up a little property policy and you'll send me a paid receipt and the closing and the lender is going to stick it in their file and we move on. That's how most of these guys write these policies. They do them all day long. They don't even know what's in the policy, right? But all their investor is trying to do is rush to the closing, get what the lender wants, yet the agent doesn't know what you need. The agent doesn't issue a policy that you need, and the lender doesn't read the policy. And most real estate investors don't read their policies. And that's not just real estate investors, that's the general John Q public, right? Most of us don't even read them. And you stick them in the file and move on. Out of sight, out of mind. I've got 136 things to do. I just checked off one of the boxes. And the majority of them, and I will use the word crap here. Most of them
Yeah.
are crap policies. They just
Yeah.
don't cover what you've got, and you don't know what you don't know, and so don't trust your GCs just right out of the gate. Hold them accountable. Make sure they got the proper stuff. But on the other side, you've got to make sure your policies are proper.
So, Mike, one, we need to have an attorney review anything we sign before we sign it. But
Of course,
anything insurance related, Mike, I mean, who reviews that before we sign it? Do you review that?
I can.
Do we count
Yep,
on our attorney to review that? I mean, is our attorney going
both.
to review something and look at it and says, yes, that covers you for insurance purposes? Or do we have you review that? Or how do we
It's
get?
both. It's both because simply put, JJ, my carriers for the general liability side, here's what they require. They'll have you send us a statement of qualifications, right? It's another word for a resume. It's just a one paragraph. Hey, I'm JJ. I live in LA. I've been flipping for 10 years. I've done 35 projects. Here's the average values. That's a statement of qualifications, right? We collect that from every client. We collect a sub agreement from every client because our GO carrier is going to have minimum requirements, right? They want to see that you have a sub agreement. Well, I will not write insurance with someone that doesn't have one, right? Because we're trying to transfer the risk and mitigate my carrier's risk. Well, how do you do that? Through a sub agreement. So we'll review that sub agreement, and I'll say the majority of them are, and they're good sub agreements. They just need a little tweaking, right? So that your attorney can look at it, but we'll also review it because when you present it to the carrier, they're going to review it and they're going to say this meets our criteria. And that's why the program has performed so well, is because we just don't hand it out to everybody, right? And that's not a pitchy sales pitch that my program's only for
Yeah.
10 people. No, it's just we underwrite it. We do proper underwriting.
Yeah, let's I want to move into that. As an
Yep.
investors, I mean, in my particular case, I've acquired the home that used to belong to my parents. It's
Mhm.
not an investment property. I'm going to move in there as a personal residence, but we've done a demo. I'm in communication with a contractor that had me sign something up front, but we haven't even got to the build yet. So I know I need to probably have you and my attorney review the existing agreement because it seems to me that I may just have to terminate that agreement and say, thank you for everything we've done up till now. I'm going to pay for everything we've done up to now. But if we're going to proceed from here on out, I'm going to need a new agreement because your prior agreement didn't entail the proper verbiage for coverage. Tim Clark, you are on. Mike Stelljes, what's your question?
Hey, thanks. Hi JJ. Thanks for putting these on. Appreciate that. Thanks, Michael, for all your knowledge. Uh, hey, my question is, and maybe this is too big of a question to answer in this short time, but what are we looking at? Just round numbers cost. Like, go back to the example you said there was a five
Yeah.
hundred
No.
thousand dollar structure only policy. What are we looking at? How much is this going? How much do we have to
Yeah.
budget for this?
Yeah. Well, and that's the thing. And here's the only thing that surprises me, because I think what's not scares some real estate investors, but when we talk about these blanket programs, they start hearing these numbers on an annual basis and like, whoa. None of these policies, you don't pay them fully, right? You're getting an installment plan. You're not having to pay them all up front, but some of these guys get cold feet like, oh, this is going to be $40,000 a year. But hey, at the end of the 12 months and you buy all these individual policies, you ended up paying 60,000. It's just because you're only paying 1,500 at a time. You're like, oh, it's a piece of cake. Here is another huge advantage of my program, right? Your builder's risk. The rate in the majority of the states is 30 cents. It's that simple, 30 cents. It's going to be 45 in the Florida area. It's going to be about 30 to 35 in California. If you're at the coast, East Coast, right, with hurricane issues, you're going to pay a little bit more. The Midwest might be creeping up just a couple cents. Kansas, right, Oklahoma, because that's in Tornado Alley, things like that. So we do take into consideration where you're working. But for the majority of the states I write in, it's 30 cents. So let's game it
So
out, right?
30 cents per.
Right. I'll give you an example.
Okay, perfect.
Right. It's right. So let's say you say, Mike, I'm going to do 10 projects a year. The average existing value is 200,000, right? It's the average. That's 2 million bucks right there, right? And then let's say your average rent is 50,000. So now you've got 2,500,000 in completed values. Well, multiply that by a 30-cent rate, right? So it's 2.5 divided by 100 times 30-cent rate. But see, I can do it in my head as far as 2.5 million at 30-cent rate. It's going to be what, 7,500 bucks a year? That's it. That's what the builder's risking. Now there's a couple endorsements that I add on that might be a 300 or 400 bucks extra, but the beauty of even a blanket program is you're going to know what your rate is, right? So you're going to know how much to allocate towards that project. Because yes, you're supposed to be allocating 100% of your overhead back into the project, right? If any contractor eats those costs, where you're not going to make a lot of money, but you're going to know on every project what you're putting into it, right? Now, general liability, I can give you a good example. I can give you a fairly firm number. It's going to be $7 rate based on your subcontracted cost, and that's per thousand. So remember, we used 50,000 for each project, right? For you on renovations. So that's 500,000, right? Divided by 1,000, multiply that by 7. Now there are minimum premiums with my GL. So it's probably going to be 2,500 to 3,500 bucks. May creep up a little bit more than that. But if I just gave you a $7,500 plus, let's call it even $4,500, you'll be paying 12,000 bucks for those two policies, where I can guarantee you'll be paying more than that, and you're going to have policies that don't cover a whole lot, right? You get the Johnny and Susie premises, and then on your flip, God knows what you're covered for. You're probably not going to be covered for a whole lot. Every now and then, if you have a property carrier that adds on the renovation endorsement, that's just going to increase their rate a whole lot more. I've written 5 guys in Northern Florida in the last month and a half, and I cut their cost by half. because their rate was 80 or 90 cents just on the existing, and their premises wasn't that much, but it saved them a boatload. And that's what I'm saying. I'm saving you a good chunk of money. I'm saving you on your coverages. So I call it sleep insurance. You're able to just say, hey, I'm pretty well covered here. And then time, you can't put a cost on your time. But look, every now and then I've had clients that I've written, they're like, I don't care if I'm paying exactly the same. I don't have to fool with all these policies, and I got better coverage. I've been high on a few of these guys. They say, I don't care. Would you rather pay $40,000 to get nothing, right?
Mm-hmm.
Or pay $25,000 to make sure you have? That's what blows my mind is I don't care what you pay. You can pay $10,000 and I'm $25,000. Well, if you're not getting anything for the $10,000, you're just flushing the money down the toilet. So,
right, like you said earlier, if there's exclusions that don't cover what you're probably going to deal with, then you're just throwing your money out the window.
You are. You're taking a risk. Your risk tolerance just went very high. You're going to Vegas. You're just rolling the dice, hoping that you've got what you need. And again, I don't put it on real estate investors. I don't put it on the public. You're taking what the lender was requiring. You're taking what the agent's giving you and just saying, okay, well, I guess I'm covered. And the only way you know you are or aren't is when you have a claim. And that's that's never when you want to find out you don't have coverage, is when the claim comes in, right?
So,
Exactly.
Otherwise,
Mike,
it's like,
in this particular case, Tim can get with you.
Yeah.
And he can discuss.
Absolutely. Didn't mean to go too long.
Absolutely. I appreciate it. That gives me some ballpark numbers to work with. Appreciate it, Michael. Thank you so much.
Tim, did we answer your question?
Yeah, no, that was great. That's exactly what I wanted. Just some rough numbers that I could work with. And do you cover real estate investors in all states or only certain states? I'm
in 42.
Okay.
42 states. Like I said, I'm not. I have my non-resident license in Alaska, but that not necessarily the carrier goes there.
No.
But yeah, 42 states. And again, I'll say this just real quick. My girlfriend gives me a hard time. She's like, don't spill all the cookies in the lobby, right? You need to hold some of this, save it. She's right to a degree, but that's how confident I am in my program. I don't care if a competitor looks at this video, and I don't care if you write it down and call another agent and say, can you beat this? I'm not about trying to beat someone. I'm going to give you coverage on a blanket basis that nobody else is going to be able to do. Yeah. And I guarantee you their coverage isn't going to match. And even if they do succeed in those two areas, they can't compete with me on the rate. And the only reason why my rate is the way it is because the last advantage to you guys is my builder's risk carrier and my general liability carrier look at the book, my total. So if JJ has a $150,000 claim, I'm not coming back and jacking his rate the next year. They're looking at my book of $3 or $4 million in premium and say, wow, you're at 10% loss ratio. We're going to hold the line on the rates for everybody.
Troy Caudell, you are on with Mike Stelljes. Troy, what's your question?
Well, I kind of feel silly asking, but being that I have not had much experience with fix and flips yet, even if your general contractor is licensed, insured, and bonded, I should still check in on this insurance?
Well, again, it's are you mitigating your risk by dealing with one general contractor versus having to hire 20 subs? Absolutely, right? But 1,000%, it doesn't matter if the guy's bonded, licensed, insured, he still is a subcontractor to you. So the way you transfer your risk back to him is to have a subcontractor agreement, right? I'm not saying that you have to carry a general liability policy because there are a good number of real estate investors that don't, and you are relying on that GC, but you have to have a sub agreement. To me, that's non-negotiable. That has nothing to do with me. That's protecting you because again, the sub agreement is ensuring that general contractor is going to live up to his deal with you. So even if his policy doesn't cover something that he was supposed to cover or didn't know, the sub agreement is going to go back to him and say, it doesn't matter if your insurance covers it. You got to pay for it. You're not paying for it. You didn't do the work. Meaning you, the client.
Yeah.
So yeah, okay. And right. Very simple. And then on the builder's risk end, The reason why you don't want the GCs or the home or the GCs pulling the builder's risk or the property is you're putting it in someone else's hand when you have no idea who they're using, what they're doing. So even my large custom home builders, right? We write the builder's risk because 10 custom homes have 10 different agents and they write it 10 different ways. And if there's an adjuster involved with the claim, nightmare. You want to control as much of the risk as you can.
One, I want to thank you for coming on today, but I also want to talk about if people want to follow up with you, what's the best way to reach you? Is it your MySpace page? Do you have a website? We talked about your website.
Let's have them go to the website because it does give my email address and cell phone number. It's the easiest way. It's an easy website to get to. And again, I don't say this like, oh, you're going to miss out or take advantage of this offer now or it expires. But I'm not kidding when I say this. What blows my mind is there may be 150 people, there may be 15 people that watch these podcasts, and I only have about 10% of them reach out to me. And again, it's not because I do have a great program in place. I really do. But it's just, it blows my mind that they'll hear this and say, all right, I'll just go back to pulling my 60 policies a year. He was okay. Insurance puts me to sleep. I don't really care. It's weird that the percentage of people that actually follow up with me in contact is lower than usual because I have one real estate investor group in the Midwest in Columbus, Ohio, that's really been pushing me too. And they follow up. They're like, they got these client, they're like, man, did this student follow up? You did anything? I'm like, no, I only had 5 of them. And it just, now when they do reach out and they do actually go through the process, they almost always follow through and sign up. It's weird, right? Because again, it's very simple. It's easy. I'll end it with this because yes, you've taken up some valuable time on a Saturday. Is I do the jumping off point for this program though is at least 10 flips a year, right? I don't write single shot policies unless JJ has a blanket policy with me for his 10 or 15, 20 flips. And then he comes with me with a one-off, right? Hey, Mike, I'm doing my house. It's worth $1.8 million. I'm doing $1.5 million in renovations. So that's a $3.5 million policy we need to write. I'll write you a single shot on a one-off like that because it doesn't fit into the box of the program. But I don't write the single shot policies just for, anybody that calls up, right? It is a blanket program. So we're talking about clients for 10 and up. And if you're not quite there yet, that's where you just kind of hold tight. And then when you start reaching that number, then we'll talk. It's only purely based on a time factor for us because we handle so many clients. It's much more difficult to start writing, 300, 400, 500 single shot policies because again, on single shots, you ask a lot more questions on the underwriting, spend a lot more time on it. Whereas a blanket builder's risk, we quote it, get it out to you, and that's it. It's turned over more to the customer service side of our agency where you're just asking for certificates, right? Coverage questions, you still come to me. So that's it, guys. I really appreciate your time. Saturday afternoon is not the best time to listen to insurance, but most of the seasoned real estate investors out there are like, we never talk about insurance. One of the least things we talk about, and we're just fulfilling lender requirements. And the lenders don't know what they're asking you. They don't know what they're getting. Yep, that's it.
Mike, to bring that back to a summary, your website is MikeSteljes.com. And
Yep.
it's MikeSteljes.com. And your follow-up phone number would be 704-779-1582.
Yep, that's my cell number. Yep, absolutely.
Perfect. Mike, I've got one last question for you. I'm always talking about networking, the importance of marketing ourselves, building relationships. You've been in the industry for insurance and real estate insurance for a while. Thereby in the real estate industry for a while. You've seen a lot of, I'm sure, new investors, experienced investors come across your path, as there are many new and experienced investors coming across our path every single day from multiple education communities. In your opinion, what's the importance of networking? What's the importance of marketing oneself for the new or experienced investor as they build their business? How important is that to you for these people that are coming
Right.
out every day?
Well, being in investor groups like you, for the new guys, man, they're getting a playbook and they're not having to pay $100,000 to get the playbook, right? So, and they're learning. You're hearing about the wins, but you're hearing about some of the horror stories, right? So it gives you a good base to go from. Last thing that I'll say about that, networking is if you have a guy in Staunton, Virginia that comes into a group like this and hears about a deal in California that he would have never heard about otherwise, he might be, hey, I'm ready to jump in on this deal. It's a multifamily. I've got the cash. I want to jump in. So this actually brings business to a lot of real estate investors because they're now able to literally be on a nationwide basis. You know what I'm saying? Versus just in their backyard. So the marketing gets you out there. You talk about where you're interested in investing. And when you post something and say, hey, I've got a deal in Texas and it may be too far away for you to handle, but I'm going to be in charge of it. Let's find someone that wants that deal. Who wants to take it from me? Who wants to work with me on it? So it actually brings business to the seasoned investors. And for the newbies, it helps their learning curve. It is tremendous. What a community. And people love to help each other in these communities. That's what I like about it too. They're not holding it to their vest and acting like it's a secret. They genuinely want to help out because there's plenty of work to go around, as we know. I mean, we're in an industry right now that's red hot. It's slowed down a little bit from interest rates, but you know what I'm saying? It's not like if JJ gives the playbook in Southern California, all of a sudden his business is going to be cut into. No, tens of thousands, 100,000 homes around the area. You can't cover it all.
And to follow up with a second, maybe more specific question.
Yeah.
For the new or the inexperienced investor or the
Yeah.
experienced investor that's new to the social media platform.
Yeah.
What's the importance of joining a group like mine?
Well, it's been partly answered, but think about it. This is unequivocally, I've known JJ since 2018. And it was more of a Southern California based group. And it became more of California. Then it became a 3 or 4 state area. Before you knew it, he's got a network across the United States, right? And it's having people from different areas of the country too brings you a little bit of perspective. Sometimes you can be in a bubble, right? Oh, I'm in Southern California. We're having to deal with all this and blah, blah, blah. And then you start talking to people in other states, like, it opens your eyes, right? It's all I say is it's like becoming a global community instead of a little local community. And unequivocally, I think JJ has the best network. I'm not saying this is the truth. I've been a part of a lot of these. JJ has the broadest, most comprehensive network of people that know what they're doing in the United States. And I've been a part of 50 plus groups across the country, and I love it. I just as a consumer, man, just as someone that likes to read some of this stuff and say, wow, look at the information that's getting out here that people are sharing. And JJ, last thing, and this really is the last thing, any new real estate investor that I bring on, the first thing I mention when I bring them on is, okay, I've got you on as a client now. Now you'll be doing yourself a big favor if you just look up JJ is easy and join his group. Because it doesn't matter if you've been doing this for 15 years and do $1 billion in deals. We can all learn.
Yeah. It's so important. Again, our network is our net worth. It's not who we know, but who knows us. Everything, it's about building relationships, not chasing the deal, but chasing relationships, surrounding ourselves with the right people. Like January Batten, for one, she's on the call, but she's a phenomenal woman who's building her business, building her network, and it goes by the people we surround ourselves with.
Look what you did in 15 minutes, JJ. You really helped some people with their social media, right? I mean, seriously, you gave some really good tips. You weren't billing them $50 an hour or paying some IT person, $500 to tinker with their website. I love that kind of value. That's what we're here for.
It's about helping one another. If you guys are on the call right now on YouTube, you guys are watching on YouTube weeks or months down the line, please like Mike's video. Please put what your takeaways are in the comment, what you found informative, some of the key things that Mike pointed out to really help you guys. Again, maybe you might want to put something on how I can improve what I'm doing as far as the quality of the content that we're bringing you, or are the videos too long? Are they too short? I know they're long, but we're bringing you great content. Again, please put what your takeaways are. If you guys are on the call right now, do not go away, because as we end the call, we're going to go to the breakout rooms and go to some more live networking. But again, Mike, I really want to thank you for coming on today. Unbelievable content. Again, if you guys want to follow up with Mike, it's MikeSteljes.com. If you want to follow up with me, click this QR code here, register for my group, be a part of what we're doing every single day, every single week. And again, Mike, I want to thank you for everything. And Mike, I guess we're going to follow up with everybody through Instagram, LinkedIn, and of course your website, right?
Yeah, go through the website, and I won't be a part of the breakout session because y'all just go in and do your thing. That's just I've actually got to get out and do some things. But the girlfriend's waiting. We're ready to get back out.
There you go.
Reach out. Thank you very much, JJ. What you guys do is incredible. Really appreciate it. Look forward to seeing you in a couple of weeks, my man.
All righty, Mike. Thank you, and everybody else on the call. Thank you so much, and we'll see you guys all out in the world of social media.